Well, speaking of calming things down, one of the other, I guess, market indicators that you use or models is your CPM, your correction protection model, if I remember that correctly. So maybe talk a little bit about that because that does tend to be a little bit more. Let's let's stay in for the trend and make sure we're out when it turns. What is your correction protection model telling you?
That, well, the difference, the A6 again is meant to be an EKG for the market every day. I want to see every little bump. I want to see every little wiggle. The CPM is a model that we actually trade. I traded it for my own account. We traded for our clients. We're managing money now, and we've built some model portfolios that have CPM as one of the components. The CPM is built to keep you in the market as long as possible because the market inherently goes up. When I got off the trading floor and I wasn't trading bonds or Forex or some of the commodity markets anymore, initially the stock market was easier for me because it generally goes up most of the time. So your strategy is a little bit different. So we built the model to keep us in. So CPM actually went to risk off and doesn't do that very often on November the 17th. Prior to that, it initially went back to risk on April the 24th. And then it had a short period that it was out of the market after the October 10th wild day that had the huge range. And I think right back in on the 21st of October, but we are now risk off, which means that we are pulling back our equity exposure for our
Mm-hmm.
accounts.
Yeah, so I'm marking here as the April 24th day that you mentioned. Within days, and I find this happens all the time with our stuff, John, where we're within days of each other. Here was our first signal to follow through day, but really that April 24th was the day that it was time to kind of. Oh yes, this is working. As you mentioned, the October 10th, that was nastiness right there. A lot of sideways action, and then you mentioned that the 17th, which was just a couple days ago, right there as we broke below the 50-day moving average line, and that was the first close below the 50-day moving average line, basically since April. So yeah,
Is May
um,
1st. Actually, first went above the in the S&P.
yes.
Uh, First day was May 1st, up above the 50.
hmm Up above the 50, right. Yeah. So we got above the 21-day moving average line a little bit earlier, but above the 50, yeah, shortly thereafter. I want to kind of look at some of the other charts that you're sharing with us, just in terms of the overall market. And this is the NASDAQ versus the Qs. And, we were talking before the show started about how you do a lot of things where you do these charts one on top of the other. So you can kind of see, okay, here's what's happening with the index, and here's what's happening with, in this case, the Q's total assets. So you have this yellow shaded. I take it something important here happened.
Yeah. Here's what we're showing here is this is the daily AUM of the QQQ, which we know tracks the NDX, the NASDAQ 100 since April. And what it's showing is those assets started expanding on a 21-day basis. Again, that's our tactical time period. And it tested that trend 4 times on June 20, August 1, September 2nd, and October the 10th. You could see a couple of them went through the line for a day or two or three, but money came in, and all four of those turned out to be nice short-term bottoms in the NDX if you follow the green lines up to the top deck there. What's happening now is we're spending more time underneath there and to a larger degree than we were the previous 4 times. That doesn't mean that this can't turn on a dime and be back up above the 21 day. Nobody knows what's going to happen. Forecasting is a euphemism for guessing. I mean, nobody knows. Uh,
Yeah.
but the way this looks right now is that we're starting to bleed assets out of the Qs. The Qs are where the Mag 7 is. The Qs have been where the driving force has been through a lot of the rally this year. So that means a lot to me. It's not, again, there's no one indicator, but if we look at 100 tools and 60 of them are giving us the same answer, it gives us a lot more confidence.